Financial Pickle here. There are many strategies that involve long call options like call spreads, poor man's covered calls, or just standalone long calls. But there's a hidden way you might be costing yourself money on them without even realizing it, and the money you're losing is going straight into the market maker's pockets. In this video, I'll teach you how and why it happens, and in part 2, I'll show you how you can prevent it from happening to you. It all comes down to owning in-the-money calls overnight into an ex-dividend date. When you hold a stock overnight into an ex-dividend, the stock will adjust down by the amount of the dividend. Then shortly after that, your dividend will be paid, which makes the dividend completely neutral, because you got paid the exact same amount that the stock went down. But you don't get any dividends when you own call options. So that can create situations where on the X date, your long call will lose value due to the stock adjusting down, but you won't get a dividend to offset that loss like you do with the stock. In these situations, you're essentially giving the market maker a free dividend, because they're usually the ones on the other side of the trade that benefit from your mistake. And you might be wondering how that's possible, because the market is generally very efficient and should be pricing in the dividend ahead of time. It knows that there will be a future downward adjustment to the stock on the X date, which will make calls worth less money and puts worth more money than they otherwise would have been if the dividend wasn't there. But many in-the-money calls aren't adjusted because it would create an arbitrage opportunity if they were. To help illustrate that, let's first look at how in-the-money puts react to dividends, then afterwards we'll compare it to in-the-money calls so you can see the difference. Here's the option chain on Philip Morris expiring on September 29th, 2023. The quotes are from the end of September 25th, the day before their $1.30 ex-dividend. As you can see, the time value on the in-the-money puts is about the same as the dividend. With so little time left until expiration and strikes so far from the current price, there would normally be very little or no time value on these options. And normally the time value gets lower the further out of the money you go, but that's not the case here. So because of all this, we know the dividend is being priced in ahead of time. The day before the X date, the stock closed at $93.72, and on the X date, it closed at $91.07, a $2.65 drop. $1.30 of that was the downward adjustment from the dividend, and $1.35 was from normal market movement. The puts are so far in the money that their delta is -1, which means they should move up or down at basically the exact inverse of the stock. So with the stock going down $2.65, we would normally expect these puts to go up $2.65. But if we look at the 125 strike put, it went from $32.60 to $33.95, which is only an increase of $1.35. The dividend was priced in ahead of time, and on the X date, the time value disappeared and turned into intrinsic value, which had no effect on the option price. The price of the put only reacted based on the normal market movement of $1.35. So in this case, a long stock and a short put position would both have a delta of 1 and would have both performed the same with a loss of $1.35. Another way in-the-money puts react to dividends is their time value actually goes up over time leading up to the ex-dividend date. And the day before the X date, the time value is usually about the same as the dividend, like with the Philip Morris example we just looked at. So basically the dividend is slowly being priced in over time. And I know that might be hard to believe because time value normally goes down over time, not up. But I promise there's a logical explanation for it, which I'll get into shortly. To help illustrate this point, we'll look at that same Philip Morris option chain expiring September 29th from two different dates about a month apart. This first one is from the close of August 28th. As you can see, the time value on the in-the-money puts is about 70 to 80 cents, and there's 31 days left until expiration. And the next one is from the close of September 21st. The time value on the puts is now about $1.10 to $1.20, and there are now only 7 days left until expiration. The time value went up about 40 cents, while the number of days left until expiration went from 31 days to 7 days. And during that time, the stock only went up 4 cents. Normally something like this is extremely uncommon and would pretty much only happen if the implied volatility skyrocketed, like what we saw with GameStop a couple of years ago, and that definitely wasn't the case with Philip Morris. All of these adjustments to in-the-money puts because of the dividend have to happen in order to avoid creating an arbitrage opportunity. To help illustrate this, we'll compare buying the stock to doing a synthetic long stock strategy with options. In case you're not aware, a synthetic long is designed to do pretty much exactly what a long stock would do, but instead of buying the stock, you're doing it with options. Normally, it involves selling an at-the-money put and buying an at-the-money call, but it functions almost exactly the same way no matter what strike you do, as long as the strike on both options is the same. For our example, we'll use the $110 strike. So now, let's pretend we open both trades on August 28th and close them on September 26th, which is the ex-dividend date, and then we'll compare their returns. For the stock, the purchase price is $95.88, and for the synthetic, we sell the put at $14.95 and buy the call at 10 cents for a total credit of $14.85. Then we close the stock at $91.07 for a loss of $4.81. But we also get the $1.30 dividend, which makes the net loss $3.51. And for the synthetic, we buy back the put at $18.95, and the calls have wide spreads and no bids, so it's unlikely we would be able to sell it for anything at this point, so we'll assume it expires worthless. So that makes the total loss on the synthetic $4.10. So it looks like the stock outperformed the synthetic stock by 59 cents a share. But there's still one more piece of the puzzle we haven't looked at. When we bought the stock, we paid $95.88, and for the synthetic, we received a credit of $14.85. This is a cash difference of $110.73 between the two trades. There is value in having that extra cash because you can use it to earn interest or pay off your margin balance if you have one. So we have to factor in the interest on that cash in order to make an accurate comparison between the two trades. The interest rate the options market uses for these calculations is called the risk-free rate. In the US, we use government debt called treasuries for this because there is theoretically zero chance the government will default on their debt. So now let's calculate the approximate interest we would earn on that $110.73 cash difference based on the risk-free rate. On August 28th, when we opened the trade, the 4-week risk-free rate was about 5.42%. We're looking at the 4-week rate because that was the approximate duration of our options. And we held the positions for 29 days, so that's about 0.07945 years. When we multiply the 110.73 cash difference, the 5.42% interest rate, and the 0.07945 years, we get about 48 cents of interest that we would have earned on that cash difference. This is very close to the 59-cent difference in returns on both trades, and the 11-cent difference can be explained by the bid-ask spread on the options and a slight difference in settlement times. So when you factor in the interest on that cash difference, the return on both trades ends up being about the same. So if the dividend was not being slowly priced in over time or not being priced in at all, then that means in-the-money puts would be underpriced, and you would be able to take advantage of that by doing a synthetic short trade combined with long stock. This would be a neutral trade that would result in risk-free gains. To illustrate this, let's look at our example from earlier with the 125 strike the day before the ex-dividend date. If we take out the $1.30 dividend that's being priced in, then the put option would be worth $31.30 instead of $32.60. And the calls are so far out of the money and have no bids, so realistically they aren't worth anything. So we paid $93.72 to buy the stock and $31.30 to open the synthetic short. Then the next day we sell the stock for $91.07, we get the $1.30 dividend, and we get $33.95 to close the synthetic short. All of this is a risk-free gain of $1.30, which is the amount of the dividend. So on in-the-money puts, the dividend has to be priced in ahead of time in order to avoid this arbitrage. So now that we've looked at how in-the-money puts react to dividends, let's compare it to in-the-money calls. With the calls, everything should theoretically function the opposite way as the puts. So that means instead of the time value going higher leading up to the X date, the time value would actually go down quicker than normal leading up to the X date. And the day before the X date, instead of the time value being roughly equal to the dividend amount, the option should be worth less than intrinsic value based on the dividend amount. Now let's look at the same option chain we looked at earlier the day before the $1.30 X dividend, but this time we're looking at the calls. They're so far in the money that their delta is 1, which means they should move up or down basically the exact same as the stock. Like we said before, on the X date, the stock went from 93.72 to 91.07, which is a loss of $2.65. But as an owner of the stock, you get the $1.30 dividend, which makes the net loss $1.35. And if we look at the 80 strike call, it went from 13.75 to 11.10, which is a loss of $2.65. But you don't get any dividends with options. So in this case, the stock outperformed the long call by $1.30 in just one day, even though you would generally expect them to perform about the same because of the delta on the call being 1. The in-the-money put we looked at before moved only based on the normal market movement of $1.35 because the dividend was being priced in ahead of time. But the in-the-money call moved based on the entire $2.65 because the dividend was not being priced in. Like I said earlier, in order for the dividend to be priced in ahead of time on in-the-money calls, they have to be worth less than intrinsic value. So that means the day before the X date, our 80 strike call would have been worth about $12.45 instead of $13.75. But that would never happen in real life because it would create an arbitrage opportunity. Options on stocks and ETFs are American style, which means they can be exercised anytime. You could buy the call, then immediately exercise it and sell the shares for a risk-free gain roughly equal to the dividend. So within the money puts, the dividend has to be priced in ahead of time to avoid arbitrage. But within the money calls, the dividend has to not be priced in ahead of time to avoid arbitrage. This means that many in-the-money calls are actually overpriced if there's an ex-dividend date before they expire, especially those that are close to expiration. Then on the X date, they adjust down to a more realistic value. So if you don't get rid of your overpriced call option in some way before it adjusts down on the X date, then you're basically giving the short call holder money for free, which is likely a market maker. And if your call is deep enough in the money, and if there are multiple X dates before it expires, then it's possible you could give away free money multiple times with the same option. Market makers know about all of this, which is why it's so common to get assigned early on short in-the-money calls the day before the X date. They're exercising their in-the-money calls because they don't want to give other people money for free. We can actually see this happening by looking at the open interest from one day to the next. For example, here's Altria Group the day before and on their September 14th X date. The number of open contracts on these particular strikes went from a couple thousand to basically zero. However, sometimes a lot of contracts remain open on the X date because retail traders like you and I didn't make the optimal trade. For example, here's Verizon before and on their April 6th X date. Hundreds of contracts remained open on in-the-money calls that were overpriced. This resulted in about $27,000 being given away for free to the short call holders on these particular contracts. There's also extreme situations where you can lose a significant chunk of your account or even go negative just because of a dividend if you leverage your account with strategies like vertical spreads. For example, let's say on September 1st you opened 100 contracts of this SPY spread with your entire account balance. You paid 80 cents each for a total of $8,000. It's now September 14th, one day until expiration, and each spread is now worth 99 cents for a total of $9,900. You decide it's worth the risk to wait one more day to collect the final $100. But the next day on 9/15, SPY has an X dividend of $1.58. So if you don't take any action on your long in-the-money calls before that, here's how it would likely play out. Your long 400 strike calls would lose $1.58 because of the downward adjustment to the stock on the X date, similar to what we saw earlier on Philip Morris. Your short 401 strike calls would get assigned early, causing you to be short the shares. The short position would gain $1.58 from the downward adjustment due to the dividend, but because you were short shares going into the X date, that means you have to pay the dividend. So both of those things offset each other. So overall, this would be a loss of $15,800, which would cause your account to go negative, all because you held that overpriced in-the-money call into the X date. But you won't lose money from dividends on in-the-money calls on the X date every time because not all in-the-money calls are overpriced. The most you can lose on each X date is the full dividend amount, but sometimes it's a bit less or even zero. It mostly depends on how far in the money the option is and how long it has until expiration. So how do you determine whether or not to take action on your long calls before the X date in order to avoid giving away free money? And what exactly should you do? All of that and more will be answered in part 2 of this video. If you don't want to miss it, go ahead and hit that subscribe button. And in the meantime, check out some of my other videos. And remember, don't be a pickle and stay out of the jar.